How do you measure the value of a dollar? Let's find out. Ladies and gentlemen, welcome to Somewhat Scholarly. My name is Alan Hibbard, and today we are exploring the question, how do you measure the value of a dollar? And today I want to show you 3 different methods for valuing the dollar, but of course these 3 are not the only 3 methods you can use. There's plenty. And at the end of the video, I'm going to give you a bonus 4th method. Okay, so make sure you stick around for that. It is a fun and infuriating thought experiment. So check it out. And also, just so I don't forget, I am doing a live stream this Saturday, December 19th at 12 p.m. Eastern Time. So if you or someone you know is interested in Bitcoin and they want to ask me questions, have them attend my live stream. So they can ask anything they want and I'll answer their questions for as long as it takes. Hopefully maybe about an hour, but we shall see. So check it out. All right, method number 1 for what is the value of a dollar? Well, a dollar is just a dollar, right? And I think this is how most people think most of the time. So if I were to ask you, what is the value of a Bitcoin? You might say $19,000. If I ask, what's the value of your house? You might say $100,000. And if I say, what's the value of a dollar? You say, a dollar is just a dollar. What do you mean? And you might even say, the question doesn't make sense, right? I've heard people say this many times. The question doesn't make sense. And I think this is how most people think most of the time. It's very natural. It's very intuitive. However, it tends to be very costly in the long run. In other words, you're probably losing value from your life that you don't need to be losing. So hopefully I can convince you of that when we look at methods 2 and 3. So let me give you a quick scenario. Suppose, for example, that you start with a certain amount of money in your bank account. Let's say $251. And you'll see why I picked that number in just a second. And this example, by the way, comes from a thought experiment I was doing just the other day when I remembered, what was the first time I had a bank account? And I thought, it was more than 20 years ago. I don't know the exact date, when my grandma took me to the bank account and she opened one up for me and she deposited some money, and I don't remember the exact amount, but let's suppose it was $251. Again, you'll see why in just a second. So again, if that was 20 years ago, right, I still have that bank account, by the way. It's my primary bank account all these years later. The question is, the original money that we put in together, how much value has it gained or lost? Well, first scenario is, suppose I started with $251 and I still have that money today. Did my value go up or down or stay the same? If you said it went up, you're crazy. Where are you getting that from? Okay, if you said it stays the same, I understand why you think that, but I'm here to tell you you're wrong. And if you said it went down in value over time, I would say absolutely. Now the question is how much? We're going to do a calculation in just a second, and there's more than one way to calculate the amount of value we have lost, but we most definitely have lost value. We didn't lose dollars, but we lost value. Okay, let me give you a second scenario. Imagine we want to avoid losing money to inflation. Okay, so we know that if we keep the same amount of dollars in our bank account over time, we're going to lose value because the prices of goods and services goes up over time, right? So our dollars buy less. So suppose we want to avoid losing money to inflation, and we decide that we're going to save $1 every month and add it to this number, right? Just $1, right? That way we keep accumulating value, or so we think. Imagine we started 20 years ago in the year 2000, and today it's 2020. Well, if we save $1 a month for 20 years, right, that's 240 months, so $240. So $240 on top of 251 is $491. Okay, now in this scenario, did our value go up or down or stay the same? Well, obviously the number of dollars went up, but what about our value? Now, if you said that our value went up, okay, I understand why you think that. If you said it stayed the same, okay, I also think that. I mean, I also see why you think that. And if you said it went down, okay, I can see that too. Really, so any answer is not a bad one. The right answer is sort of it depends, right? How do we do the calculation? And this is where we start to think about method 2. And method 2 of valuing a dollar is that a dollar is stuff. A dollar is stuff, right? A dollar isn't just a dollar. A dollar is the stuff you can get for the dollar, right? And that amount of stuff can go up or down over time based on how prices change, right? Price inflation. Another way of thinking about this is that inflation is a hidden tax. So generally speaking, things are going to cost more dollars in the future than they cost today, right? There are obvious exceptions to that, but generally that's what happens. And that's because we keep creating more dollars like every minute of every day without end. It's crazy. So it takes more dollars in order to buy stuff. So the example I want to use here is actual price data of cheeseburgers, but not just any cheeseburgers, Big Macs. Big Macs from McDonald's. So thanks to the wonderful efforts of The Economist, we have access to the price of Big Macs all over the world, all different countries, all different currencies, since the 1980s, I believe. And so today we're just going to go back to the year 2000, right, simulating that example of my bank account, trying to answer the question of how much value did I gain or lose since I opened that bank account with the original $251. All right, well, let's see. Let's measure first the price of a Big Mac over time. Let's see what that looks like. Well, in the year 2000, a Big Mac cost $2.51 on average in the United States. $2.51. And in the year 2020, the price has gone up considerably to $5.71. So, if we go back and answer the question, how much value did we gain or lose? Well, we got to do a little bit of math, but you can see already that in both scenarios, we lost value, significant value. In fact, the second way of thinking, right, method 2 of valuing a dollar is how much stuff can you buy. You don't even think about it in terms of dollars. You actually think about it in terms of the stuff. So in other words, I don't think about a bank account in terms of how many dollars it has in it. I think about a bank account as how many cheeseburgers it has in it. Okay, this is kind of crazy, but let's see what that looks like. Well, in the year 2000, when I opened the bank account and I had $251 and a cheeseburger was $2.51, I basically could afford 100 cheeseburgers, right? That was essentially the balance in my bank account, was 100 cheeseburgers. 100 cheeseburgers. Ooh, we should put units. BMs, Big Macs, 100. So we started with 100 Big Macs. And in 2020, when the price was $5.71, and we had $491 in the bank account, if we divide this, we find that we only have 86 cheeseburgers. We can only afford 86 cheeseburgers. So our value went down, right? We are less wealthy after 20 years. Even though we kept adding $1 every month, for 20 years, we have fewer Big Macs, fewer cheeseburgers. This is, I think, a better way of thinking about value, right? The value of your dollars, the value of everything you own, right? How much stuff can you buy? This is so much better, so much more meaningful, because you can't eat $1. You can't eat this, right? You can eat a Big Mac, you can eat whatever else. So it doesn't really matter how many dollars you have. It matters what the dollars can buy, right? It matters how much stuff you can get for the dollars. And as we go back to the first scenario and we think, okay, what if we just kept $251 in our bank account the whole time for 20 years, didn't add to it, didn't touch it, then how many cheeseburgers can it buy us at the end? Well, quite simply, it's going to be $251 divided by $5.71 per Big Mac. And you find that you get 44. And as we go back to the first scenario and we see, okay, how many Big Macs can we afford if we don't add any dollars to our account for 20 years, right? If we just keep the original $251 for 20 years, don't touch it, right? We think we still have the same value in our account. but really we can afford way less cheeseburgers. In this case, it's going to be $251 divided by $5.71, and you find that we can only afford 44 Big Macs. So in other words, right, it doesn't really matter how many dollars my grandma gave me when I opened my account, right? Those dollars have probably been there for 20 years, right? And I've added other dollars, subtracted them, added, subtracted, whatever I've done with my account. But whatever those initial dollars she gave me, maybe it was $10, maybe $100, maybe $251, I don't remember. They've probably been there for 20 years. And they've lost so much value. They've lost 56% of their value, more than half in just 20 years. They've lost more than half of their value, measured in stuff, right? Which I think is the right way to measure the value of what we have, right? In terms of stuff. This is a much better way of thinking about it than this way. And let's go through some of the other ways of thinking about it for these two methods. Some of the other ways of thinking in terms of method one are these items down here at the bottom. In other words, more dollars equals more wealth. This is a very common thing. Like, okay, if I have more dollars, that means I'm getting wealthier, right? It makes sense. Like, it's very intuitive, and at first you wouldn't question it. But hopefully when you see this type of calculation and explanation, you would start to question it, right? And if you find yourself thinking in this way, like, oh, more dollars means more wealth, hopefully you catch yourself, right? Because it's not necessarily true. In this method two thinking, more stuff equals more wealth. And to me, that makes a lot more sense, right? Because, of the explanation I just gave. Price is a property or a label. So if you go to a store and you're going to buy a shirt, right, and it says small, medium, large, made of cotton, $10, whatever else, one of the ways of thinking is that price is just a label, right? It's just like a feature of that item, and that's just what it is. And to me, that's a very fixed mindset, and it's not very helpful in terms of, increasing your wealth. A better way is price is a rate or a ratio, right? A rate or a ratio. So just like you might have $10 per shirt, right? You could say one shirt is $10. Sure. Okay. It goes both ways. So $10 per shirt, but you might also say like $1 is a tenth of a shirt. So you can measure what $1 will get you, right? Not the number of dollars it takes to get one shirt, but $1 buys how many shirts, right? And it might be a tenth of a shirt today, but only 1/20th of a shirt in a few years, or 1/100th of a shirt far out into the future. So if you measure it the opposite way, right, if you just take the normal price of something and flip it upside down, you can see the strength of the dollar over time. Let me show you an example. So let's use simple numbers for this one. Suppose something costs $2 today, and eventually it's $5. Right? Over the course of 20 years. Let's say it's a shirt or a hamburger. It doesn't really matter what it is. Well, this right here, the upward sloping trend, right, is just measuring price. We know price is going up. Okay, no big deal. What's the value of the dollar doing during that same time period? Well, it's just the inverse. We can just flip it upside down. So it's really 1 divided by 2, 1 divided by 5, and 1 divided by all these points in between. And the graph is just going to be downward sloping. So in other words, the second line here, downward sloping, that's the value of the dollar over time. It's going down, right? And when we think about investing, right, in Bitcoin or stocks or whatever, do we want the slope to go up, or do we want the slope to go down over time? Right? I mean, it's not a trick question, right? Like if you want the graph to go up, right? You want price to go up, right? That basically means that particular asset is getting more valuable. So if you see that the graph of the dollar does this over time, it goes down, why would you hold the dollar? It's a terrible asset. It's terrible. It's just going to go down, measured in cheeseburgers, measured in Bitcoins, measured in ounces of gold, measured in prices of t-shirts, anything, almost anything, right? The dollar is going to go down over time, right? And that's just the opposite of the price of the asset going up. So I'll come back in just a second and explain these last few items at the bottom here. But what I want to do right now is start talking about method 3. A dollar is time. Right? A dollar is time. So it's not just a dollar is a dollar or a dollar is stuff. a dollar is time. This is a third way to think about the value of a dollar. Time is money. Okay, we've all heard that a million times, right? Time is money, money is time. But this goes beyond just saying it or hearing it. It's really thinking about it that way, right? Thinking about a dollar in terms of leverage. Basically, the ability to give someone a dollar and say, I want your time, right? Here's this, do something for me. And we do that very often, right? If you go to a coffee shop and you pay for a coffee, you're saying, I want your time. I want you to brew the coffee. I want you to pour it into a cup, and then I want you to hand it to me, right? And do whatever else, add some other ingredients. And so you are buying someone else's time whenever you shop for anything, but you might not be thinking about it that way. And the point I want to make here is if you think about a dollar in that way on an ongoing basis, it's really going to change your relationship with money for the better. Big time. It's something that I've been trying to do a lot lately, and I'm not quite there yet. Most of the time I'm thinking in terms of method 2, but I want to get to the point where I'm thinking about method 3 all the time, right? No pun intended. So yes, a dollar is time, time is money, and really what this is leverage, right? It's buying other people's time and trying to get way more out of a person, a skill set, a team of people in the long run than you give up in the short run. So this is really investing. This is what I would call investing. If we go back here, whereas this is saving, right? When you're just accumulating dollars, that's really saving, and you're focused on the dollars themselves. For example, $10. Whereas method 2, focusing on stuff, your emphasis is on speculating, and you might be thinking in terms of percentages. Method 3, your emphasis is on investing, and you're thinking like 10x, right? You're thinking about multiples. You're trying to multiply your wealth big time. So I'll elaborate on that in just a second. Let me finish these other ones. Going back a step, method 1, you have a nominal focus. Like you're just focused on the dollar amount, 251, 491, right? Whatever the amount is in my bank account, whatever it says on my monthly statement, right? I have this many dollars, right? And that's my monthly statement. I want that number to go up, and if it goes up, I'm happy. And that's sort of the end of your thought process. Method 2 is like a real focus. You're focused on what those nominal dollars can buy you in the real world. And for those of you guys with any background in economics, you know the difference between nominal rates, nominal GDP, real GDP. Basically, you're accounting for inflation. So you can either, adjust nominal numbers by the CPI or some other GDP deflator or some other measure of inflation. Or you can adjust what you have by the price of cheeseburgers, right? That's perfectly valid. You can do it any way you want. There's no limit to the number of ways that you correct the nominal number to make a real number. And those terms are definitely in quotes because they're not like a hard and fast thing, right? It's kind of up to you how you do it. However, method 3, I have here imaginary focus. Imaginary focus. And imaginary is also in quotes because if you're thinking this way, you're imagining the value. You're basically creating something that doesn't exist yet. So you could imagine, no pun intended, you could imagine a businessman like Steve Jobs or Elon Musk or whoever that has a vision for an iPhone, right? And there were no iPhones before the first iPhone, right? Obviously by definition, but Steve Jobs had it in his mind and he said, I'm going to put all these resources together. I'm going to pay all these people for their time, for their expertise, for all their hardware, for all their software, all their raw materials. I'm going to get some real estate. I'm going to do all these different things and organize all this physical and mental resources to create something that I'm imagining that nobody else is imagining. Right? That's what he did. That's huge. I mean, that's incredible. It's really incredible. And that's what Elon Musk is doing. He's imagining going to Mars, right? He's imagining, all the electric vehicles, blah, 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 right? In such a way that nobody else is. And he's combining a bunch of things in the real world, and he's paying people for their time, for their energy, for their resources, for their expertise, and putting them all together to make something that doesn't exist in the real world. It's only imaginary, right? And by the way, it's not just these like crazy entrepreneurs that are like risking their life savings and, changing the world. You've done it too. And so have I, right? If you go to school, for example, when you're young, you're imagining, right? I could imagine myself as an engineer, a lawyer, an accountant, or whatever. But like you as that thing didn't exist yet. And so you said, okay, if I pay these teachers for their expertise, and if I buy these textbooks, and if I buy a laptop, and if I, spend money on all these things and basically pay people for their time, I'm imagining a future that doesn't exist yet, but it exists in my mind, in which I am an accountant, or I am an engineer, or I'm a lawyer, or whatever, right? And you essentially invest, right? And you're investing in yourself, you're investing in your own future, and you're trying to multiply your worth as a person by orders of magnitude, right? Imagine if you couldn't read or write. Imagine if you couldn't speak English. Imagine if you couldn't do those things. There's really no amount of labor that you could do in a linear way to achieve, being an accountant or being a lawyer or being whatever. At some point, if you want to elevate so many orders of magnitude up, you have to think like this. You have to think like method 3. Hopefully that makes sense. Last few items here. Avoid or ignore risk. Generally, when you're thinking this way and you're just trying to accumulate dollars, you're avoiding or ignoring risk. And sometimes these people are also ones who have a pension at their company. Maybe they're a teacher and they have an a retirement account, or they could work at any company, have a 401k. And generally speaking, right, not always, this is a huge oversimplification, but generally speaking, these types of people, when they're thinking in this way, are trying to avoid risk or ignore it altogether. So many times I ask people, first of all, I ask people, what's the value of $1? And they say, what do you mean, right? So I actually do that. And then if we keep talking, then I say, okay, do you have a retirement account? What's in your retirement account? And usually the answer is something like, it's like a growth fund. And they don't know what's in it, right? They don't know if it's stocks or bonds or whatever. And sometimes they'll come up with, it's a mutual fund, I think. Right, yeah, mutual fund. But I'm like, what's that? And they're like, I don't know. So they don't know what they have, right? And I don't blame them, because this stuff is not taught in school, and it should be. But generally speaking, people are avoiding those risks altogether. They don't know if they're holding risky things. They don't know if there's anything they can do to mitigate the risk. They don't know if there's things that they can change that are within their control. They're just sort of ignoring it, right? And they're either just accumulating dollars in a savings account or a checking account or in some fashion like that, or they're sort of like ignoring the risky stuff. Whereas in method 2, these types of thinkers tend to embrace or tolerate risk. These are the people who they know what they're holding. Like they can tell you they have stock in, whatever companies, they have bonds for whatever companies, they either own gold or Bitcoin or whatever, and they can tell you why. And they can also tell you when they got in, right, how much they paid for whatever they have. They can tell you when they're hoping to get out, probably in a lot of cases. And they might even be able to say, right, thinking of price as a ratio, they might even be able to say things like, you know what, I bought Bitcoin when it was cheap, and when it's high, I'm going to sell it, right? Buy low, sell high. But then I'm going to get out of Bitcoin and get into this other asset class like real estate or something like, or stocks, right? And so not only are they going to buy low, sell high within an asset class, but they're going to buy low, sell high across asset classes. So that's just one example. But ultimately, that is speculating, right? You're speculating on the price going up and down, trying to increase the amount of stuff you have by multiplying it that way. Whereas over here, we're not avoiding or ignoring risk. We're not embracing it or tolerating it. We're actually creating risk, right? Method 3, you're creating risk. At the same time, you create reward, right? So if you're trying to invent the iPhone for the first time, you're creating a ton of risk. Not only could you lose all your money, but if you borrow it from investors, you're creating the risk that they lose everything. And then if you start hiring employees, you're creating a risk that you're not going to be able to pay them. And you're going to have to fire them or lay them off. Your company could go out of business. You might, rent an office space for 5 years and go out of business after 2 years, right? And then you have to default and not pay your landlord. So like you're creating all these different risks, and even reputation risk, right? If you go and do this thing, people might say, that guy's crazy, especially if you failed and they laugh at you, right? So there's all these risks. You're actually choosing to create all these different risks for yourself that weren't there to begin with, because if you succeed, the reward is just way, way, way higher. So it's a very, very interesting way of thinking. I think it's very important that we all do it. And like I said, everyone has done it, but just maybe not consciously. So what I would encourage you to do is start thinking about it consciously. And finally, The way to do that is to start asking certain types of questions. So if you're in method 1 thinking, you ask questions like, can we afford it? Right? Can we afford it? Method 2, when can we afford it? When can we afford it? Like, when can we afford to go on that vacation? When can we afford to buy a new car? When can we afford to buy a bigger house? Right? So if you're method 1, you ask, can we afford it? No, we can't afford a vacation. We just can't afford it. Right here. When can we afford it? We'll be able to afford a vacation, once Bitcoin moons, right? Or whatever. Then we can afford it. But if you really want to take more control over your financial destiny, you start asking, how can we afford it? Right? How can we afford it? And that gets your wheels turning, right? That gets your mind working. And you say things like, all right, well, maybe we're not going to hang on to that Bitcoin and try to sell it at, $1 million a coin. Maybe we actually sell it now and we use that money to start a business or to hire people to do things or whatever, knowing that or hoping that, aiming for some long-term payoff that's worth more than a Bitcoin or more than whatever you sold in the present moment. So those are some questions you can ask yourself, if you want to think in different ways. Again, I recommend way number 3. How can we afford it? Yeah, that's a better way. And just to finish the graph here, the outcome is unknown. You really don't know. I mean, you're hoping for a huge payoff that goes so high you can't even measure it. But you might sort of spend a whole bunch of money and then just cash out before you lose too much, or you might lose everything. You might go into debt. You might have a huge negative outcome. So you don't know, right? Again, you're creating risk. You're also creating reward, and you have a lot more control over your destiny than these other methods, but you certainly don't have certainty. All right, guys, so those are the 3 methods I have for measuring the value of a dollar. If you learned something today, please give this video a thumbs up. And if you want to learn something tomorrow, make sure you subscribe. And as promised, here is method 4 for valuing the dollar. And it is a fun and infuriating thought experiment. How would you value the dollar if you were the one who created it? And what I mean is that there were a group of bankers who met in the early 1910s on Jekyll Island off the coast of Georgia, and they drafted the legislation that brought about the Federal Reserve, right? The Federal Reserve Act, which was passed in 1913. So how would you feel if you were one of the bankers who created the Federal Reserve, which created the dollar, that effectively steals value from everyone who doesn't understand it? How would you feel? How would you feel if you were the son of one of those guys, or the grandson, or the great-grandson? And what would you do about it? Let me know in the comments. Thanks for watching, guys. See you next week.